thank you for joining us today, and happy St. Patrick's Day for those who are celebrating. I want to welcome you again to our NYU faculty webinars, and today, as I was mentioning with Jim, that it's a year. It's just over a year that we switched over from in-person classes to remote learning. And as we move back to some level of normalcy, hybrid, and in September, assuming everything continues to go well, we'll be doing this in person again. So I'm excited about that. So it's been an interesting year. I want to start off introducing our guest speaker, Jim Costello. Jim and I are colleagues within the Councils of Real Estate. I've had an opportunity to get to know Jim over the last several years, and I couldn't think of a better person to join me to talk about what's this last year been like, what's the data saying, and as we look through the windshield and after looking into the rearview mirror, what do we see ahead? So today we're going to talk a little bit about kind of what that last 12 months has been like, look at the debt capital markets trends, delinquencies and modifications, capital raising and the dry powder that's available. We'll look at transactions, retail and e-commerce, prices and liquidity, and then interest rates and the other I word, inflation. And then at the end, we'll have an opportunity to answer some questions. If you do have a question, please put it into the question box. We may not be able to get to it during the presentation. I'll try to monitor it, but if not, we will try to get to it at the end. So, it's been an interesting year, and I saw this and I thought it was just appropriate. My dogs are getting to know me a lot better because they see me around all the time, but I realize that when you're in all the time, things that got my dog excited all the time, like things moving and walking and getting in the car, you learn to miss those things. But Jim, maybe if you can just give everyone a little bit of a background on yourself, and then we'll talk a little bit about what the rearview mirror has to say.
Sure thing. Hello, everyone. Jim Costello here. I work with the company Real Capital Analytics. The firm is a global supply of information on capital issues around commercial real estate. Who's buying, who's selling, who's financing on what terms. We have offices in Singapore, Sydney, London, New York, and Silicon Valley. And actually a Stockholm office as well through a subsidiary. But we've got global coverage. And it's something where we're helping people understand the price concepts around real estate. Myself, I worked for a number of years up in Boston with a firm called Torta Wheaton Research. It was set up by a professor from UMass Boston, a professor from MIT, and leveraging CB's data sets to kind of forecast where the market was going. And then I moved down to New York and started working with RCA back in 2015.
Okay, well, great, Jim. Again, thank you very much for joining us today and for sharing your knowledge and your insight. So one of the things that is a strong positive to the CMBS and structured debt markets, the rated public markets, is the amount of transparency. So what I thought might be a good way to start level setting where the market is right now is to look at the CMBS delinquencies. And I pulled this information down this morning off of TREP, which is a data source that is very, very granular at the structured finance, CMBS agency level for, all the way down to the loan level. And in looking at the last, kind of what the current status of the market is right now, I broke up the data into four major property, or I should say product type categories. The conduit transactions, which are multi-borrower transactions, those are CMBS bonds that have several loans and multiple borrowers. The SASB, the single asset, single borrower transactions, which are a single loan that might be backed by a single asset or a portfolio of cross-collateralized assets, but it's one loan. So it is typically larger and less diverse. CRE collateralized loan obligations, and then lastly, Freddie K deals. So that's agency multifamily securitization transactions that Freddie Mac issues. So when you look at the market today, and this is delinquencies, non-current loans, and then the total, you could see that there are some significant numbers in terms of the amount of non-current status. So as far as the conduit loans are concerned, there are 2,069 loans that are not current for a total of $40.9 billion. That's a pretty significant number. That's a little over 10% of the total outstanding in the conduit market. For the single asset, single borrower deals, those are typically larger. They're typically lower leverage. There are 35 loans that are not current, $7.9 billion, about almost 5% of the total outstanding. For the CRE CLOs, another 2.15 billion. And then lastly, even the agency Freddie Mac deals are showing a little over $2.3 billion of loans that are either delinquent or not current. So the thing about this data, though, it's not the full message. So when you look at the total, we have almost $53 billion of CMBS loans that are non-current. And that is a lot of transactions to eventually possibly have to work through. But the piece that's not captured here is the modifications. We've been hearing the word forbearance and modification throughout the year. And what this data captures is the amount of loans that have been modified. And that might be an extended maturity with some period where the loans have a holiday from having to pay their debt service, some modification that has allowed that loan to be changed, still in compliance with securitization rules, but also allowing for the flexibility to deal with what we've been facing over the last year with the pandemic. When you look at the total, we have almost $85 billion of loans that have been modified. Now, that's not in addition to loans that I showed you before that were delinquent, but it is giving you an indication of the size of the loans that required some kind of modification, made a presentation to the servicers to say, here's why we need a modification, and received it. This is not including the ones that asked for a modification and didn't get it. So there's almost $85 billion that have been changed with maybe a different maturity date or a different payment structure. And those are pretty significant numbers. We haven't seen that amount since in some cases the global financial crisis, and even to some extent not this much in terms of modification. So the other thing that I also wanted to look at was, of the deals that were done in 2020 and year-to-date 2021 first quarter, what did those deals look like? So in 2020, during the first quarter, so basically leading up to the end of March, where we really started to see the shutdowns occur, there were 10 conduit transactions and 10 single borrower transactions for a total of just over $20 billion. Now, of that conduit, 19.7% were retail loans and 13.7% were lodging. When you look at quarters 2 through 4, there were 26 additional deals that were conduit, 16 that were single borrower, for an additional close to $40 billion. And in the conduit, we saw the percentage of retail drop to 9.9% and lodging to 6%. Some of that was carryover from deals that had been originated already that needed to be sold, but it's still indicating that there's a change in what the expectation the bond buyers have in terms of the collateral mix that they're willing to buy. When you look at the 2020 totals, almost $60 billion of transactions, over 72 deals. In the first quarter of 2021, there have been 6 conduit transactions for a total of just under $6 billion, and the 16 single borrower deals, just under $8.5 billion. When you look deeper into these numbers, you'll see that some of these single borrower deals and conduit deals where you have retail and lodging, a lot of that was leftover that is being sprinkled into deals at a smaller percentage. And some of the retail that we have seen securitized in newer loans has come from portfolios of either supermarkets or Walgreens, CVS's, kind of net lease transactions that have more credit, that are essential uses and that weren't as directly affected by the shutdown orders and an inability to operate the businesses in those properties. Last thing I wanted to highlight was the capital that's been raised. So this chart, based on data from Preqin, is looking at historic fundraising for real estate on a quarterly basis. The blue line represents aggregate capital raised, and then the kind of aqua color is the number of funds. But I think maybe more telling is the dry powder by strategy. So the top blue line, the more blue color, is real estate opportunistic. The more aqua color is real estate value add. And then the purple or violet is real estate debt funds. So as of the 31st, as of this month, this is the amount of dry powder that's been raised globally for real estate funds for these various strategies. So hopefully the TREP data, the delinquency and the modification data, as well as what the collateral mix looks like, and then a little bit into the money that's being raised to the point of liquidity, helps lay out where we sit today and what we hope to expect looking forward through the windshield. So I will pass things over to Jim. And Jim, I guess I shared, so just let me know when you want me to change the slide.
Okay. Yeah, it's interesting looking at the dry powder chart that Tino is just showing. The dry powder, sort of how much capital has been raised to be deployed. It creates some issues because, and I've been calling it a Three Stooges effect. Maybe that's dated for some of you, but there were some vaudeville comedians. They had a routine where they would all three of them try to run through a door at the same time. With all of them crowded at the door, they couldn't get through the door at once. And that's sort of the way I think about what's been happening with property transactions and property prices, and why we haven't seen the kind of drop in prices in this downturn that we saw last time through. I'm showing here deal volume, as the blue bars, and it's, individual building cells are the dark blue, and then you get sometimes people buy whole portfolios at once, or even buy a whole company, and those are the other shades of blue. But what you can see is that, 2020, we saw a sharp drop off in line with the pandemic. It's not surprising. The orange line at the top, that's our commercial property price index, where we're looking at price trends on a repeat sample basis to show sort of, the apples to apples comparison in terms of price changes, as opposed to just what happens to transact. You haven't seen the kind of decline that we saw back in 07 to 08. In fact, it started to go up a little bit recently. And it's a different type of market. And I've got a couple slides later that go into some of those issues, but dry powder is part of that. And so if you go forward, Tino.
Thought I did.
Okay. Looking here at a breakout of the deal volume for 2020 and into January as well, by property sector, and sort of what's going on in each. For 2020, everybody was down. Even there's a lot of interest in industrial property right now. People are, they have a story that they see online shopping. There's a need for the storage of goods. A lot of investors, they want that story about what's the fundamental use. How do I know that people are going to want to be leasing the space? That story works well for them right now. And so investors are trying to chase industrial deals. Even with that, though, deal volume was down for industrial last year. So there was a certain component to the market where, even though there was dry powder capital sitting on the sidelines waiting to buy something that could give them any kind of yield in the current environment, plus a story that helps sell industrial, they still couldn't complete deals because everyone was stuck at home on their couch. So there was a restriction in some of that. That's why you see in the columns more to the left, you see better deal activity into December of 2020 for industrial, because things started to open up a little bit, and deals that were kind of paused throughout the year kind of came through all of a sudden. Into January, things retreated back to where they were in about the third quarter, but it wasn't as bad as the first couple months of the pandemic. I mean, this time last year, people were worried that we were sort of facing another end of the world type situation, just like in the financial crisis. So deal activity across everything shut down for a little bit, and that was a bit of a problem, I think, because it created a situation where you had people making decisions based on very current information, but taking that current information and extrapolating as if that's the future and everything has changed moving forward. If you jump forward one, Tino, that's.
I just want to ask one question on this, which to me popped out. When you look at January 2021 and you look at the year-over-year decline in major market transaction versus the secondary and tertiary markets, is that a little bit of a fear of where prices had gone in the New York Cities and San Franciscos, and that maybe we need a little bit more information before we buy there?
Well, here's the thing. It's 1 month. It's just January. I suspect it's more a story about January 2020 having some good deal activity. January 2020 had some fantastic industrial deals. There was the Prologis bought 2 different REITs last year with exposure to LA and Chicago industrial. And so that would have been within those major metros. Mm-hmm. So sometimes the current month of activity, if you look at it on a year-over-year basis, it's not a story about this year. Sometimes it's a story about last year. Right. I haven't dissected that figure to look at it yet, because it's also 1 month, and 1 month at a time tends to get a little bit volatile.
Okay.
But that's why, if you move on to this next slide, making a decision off of one period, can be problematic. That's a lot of futurists do that stuff, and I really dislike the type of analysis a lot of those folks have out there. They take a small movement and they blow it out of proportion, thinking that everything's changed and everything goes that way moving forward. I like e-commerce and its impact on retail. That's been a particular issue of mine. I'm looking here at some data from the U.S. Census Bureau. The blue is e-commerce share of total retail, and the orange line, I kind of fitted a trend to the sales data, and from up until 2020. You see that spike, that last spike, that's Q1 Q2 2020 rather. And it moved well above that trend, 2.5, 3 years of growth within a single quarter. And people last year at this time were saying that, oh, because of this, all retail's dead, no need for any of it moving forward. It's going to keep going up like this. It was already underway. All this will die. But if you jump forward one slide, they weren't quite right. It was a temporary dislocation with people on lockdown. You couldn't go to the grocery store, and it's already starting to revert back. Now, I'm not saying that it goes back to the previous trend. The interesting thing will be, does it come to some share ahead of that orange curve, implying that there's been a permanent obsolescence of some space from all this? Does it dip back below the trend as maybe some things sell in bankruptcy sales and reduce the cost of some of the retail real estate to make it more advantageous for owners? So I think you got to be careful. The message for me on this is you got to be careful when people have hot takes off of one quarter's worth of data without some sort of framework of understanding how those figures change the set of economic incentives that are in place for consumers and property owners. Because if it's just sort of, hey, my survey says that people want this, and that's not science, that's sociology. So if you go forward.
And Jim, I've actually gone to the mall, I hate to admit this, just to even walk around a little bit. And then I end up buying something that kind of catches my eye that I didn't necessarily go in with the intent of buying. But it's, there are people shopping, not as many, but there are people shopping, and some people just, they want to go back.
Yeah, and that'll be interesting to see how that evolves. The mall, one problem with the malls is that they're not homogeneous. There are clear winners and losers. A great example, pre-pandemic, I was out in St. Louis in the fall of 2019, and I was out there for a family thing. We were going to go to a forest preserve, and I just quickly left Manhattan, hopped on a plane, and flew out there, and with just a backpack, and I forgot to bring anything but my nice Allen Edmonds shoes. So I needed some cheap sneakers to go walking around the forest preserve in. So I went to a mall in suburban St. Louis near this hotel I was staying at. And I walk in and I'm in Macy's, and I'm halfway through the Macy's before I see a single person. And then I walk into the mall and it's dead, and I find a shoe store and I find some shoes pretty cheap. But yeah, it's the mall loan was due this year. So that was interesting. But that mall, it was a 1970s era mall that was set up for consumers tied to the manufacturing sector that was so big in that area at the time. And that local economy has been devastated. They've lost all those jobs. There's not that same consumer activity anymore. And, it's a dated mall, just dated fixtures, the brown tile, orange carpeting kind of thing, the 70s. And that's where the problem is. It's not a mall in like the Back Bay of Boston with high-end retailers, tied to high-income earners. So there's a big division in that, and that's where I think malls get a bad name, because people are extrapolating from one slice of the market that is bad, that faces demographic challenges that would hamper spending and income as we get more of an hourglass figure to the income distribution in the United States. But but it gets applied to everything. So it even gets applied to say, small local retail servicing, quick service retail or grocery stores, people are negative on that as well. But clearly, there's appetite for that stuff.
Yeah.
So in any case, prices. I want to talk about this point as well. People tend, to make decisions. My theme here is that people tend to make decisions poorly at times. Number one, listen to futurists, extrapolating from one piece of information. Another behavior that I think is bad is people tend to fight the last war. I'm lucky enough, maybe unlucky enough, I don't know, to have lived through 4 different recessions in my professional career, and every time people talk as if we're going to go through the same problems that we went through last time. That's how they base their experience and set their expectations of what they should face. But I think that's the wrong approach. So what I did here, I took our commercial property price index, which starts around 2000. That's when the firm was founded. I wish the owner had started it earlier, but that's just not. It just wasn't possible. And I spliced it onto some data sets that are kind of floating around in the industry. There's a group that was out there in the past. It was called NREI, National Real Estate Index. It was a survey-based system where they came up with some price and cap rate measures. And I spliced that onto some even earlier data from the Fed on the portfolio values of some insurance companies. And so I'm showing here price trends back to the 1950s. The orange bars, those are recession periods. And we can see that, over, the last 70 years, only twice have we seen 10% plus declines in property prices. We saw it in the late 80s, early 90s. We saw it in the financial crisis. Every recession doesn't lead to that kind of mayhem. And this time last year, people were talking as if, oh, we're going to have another recession. Get ready for 20% plus property price declines. That's the same kind of problem as before. But it wasn't. And you shouldn't expect that just because we're in a recession. This recession is more like some of the recessions we experienced in the 70s, where it wasn't a financial crisis. It wasn't a contraction in the amount of debt liquidity. It was a contraction in the real economy. There's a financial economy, the cost of money and how you finance things. And there's the real economy, how many jobs are created, how much stuff is being produced, how many, bushels of soybeans you can drop on your foot. That, is where the problem was this time through. And so the behavior should be different. We're actually showing prices starting to increase now. And although part of that is a composition issue because of so much growth in the industrial market. If you can move forward, Tino. I'm showing that here, just to break out that same price index, it's float weighted, our total index. So we have growth underway for the apartment markets and the industrial markets. There's a K-shaped recovery with those on the way up, and the office, retail, and hotel, those are on the way down. The better growth for industrial and apartment, where there's a lot of investor demand and some expectation of ongoing income growth in the future, that's helping to boost that price growth. It's an interesting divergence that we see here, though, because over most of our history, we don't see these really diverge all that much. And in part, like last downturn, they all kind of followed the same path down because that was a credit crunch. It was impacting every property sector equally. This time through, it's not a credit crunch. It's a challenge to the fundamentals of property income. And so you get a divergence in terms of the performance. So on that point, if you can move forward again, Tino, here's a story of why it's not a credit crunch. Tino was going through some of the stuff from the TREP database earlier, and that shows you a lot of the stuff from what's happening in the CMBS world. When we track all of our sales information in the United States, we're also tracking who's financing any purchases, and who's behind the refinancings as well. We're getting that same information. And I'm plotting out here, sort of the composition of lending in the marketplace. The chart on the left shows quarter by quarter, who was lending the most. The bright blue in the middle, that's the agency lenders, Fannie, Freddie, They're obviously a big part of the market. The pullback in liquidity for the debt markets in Q2, that was largely a decline for the CMBS world and what we call investor-driven lenders. Investor-driven lenders, that's going to be debt funds, mortgage REITs, the old line hard money lenders. They pulled back a little bit as well in Q2. But when it was clear that this downturn was a bit different, that there was some opportunity to take on risk, both of those groups started to originate more again. So we had a bit of a pause in debt liquidity, but it didn't collapse. And in fact, if you move forward on that point, Tino, what I'm doing here, I'm plotting out the unique number of loan originators each quarter by property type. They index it all to Q4 15. Otherwise, the apartment stuff would dominate because there's so many DUS type deals where people are tied to the apartment market. But what it shows is that the hotel market is where there were some actual debt challenges over last year. I mean, if you're a borrower and you're trying to get a loan and you've got 20 banks trying to compete to get your business versus, for the same property characteristics, if there's only 5 banks trying to compete for your business, banks or lenders, just, to be agnostic there, you're going to have better options with 20 people competing for you. And so this reduction in the number of unique originators for hotel, that's where there is a real problem. For the property sectors, it wasn't so bad. The office and apartment sectors did decline just a hair from a year ago, but it wasn't so bad. Retail is down, but there too, there's a bit of division for that smaller end of retail, tied to smaller shopping centers and kind of single tenant type retail. Activity was good. It's been on decline for a while, even before COVID, for the bigger stuff. But the industrial sector, that's the one that just keeps blowing and growing. So that's one of the reasons why we haven't seen that collapse in prices this time through. If I have a property and I have to get refinanced, I had a better opportunity of doing that this time through than I did in 08. In 2008, as the market was falling apart, were people who needed to be refinanced with cash flowing assets, but they just couldn't get refinancing because every lender was rationing their capital. The insurance lenders were still in the market, but they would only work with clients at the time who had stuck with them as the CMBS market started to take over beforehand. So there were people who had to throw their keys back to the lenders, even though they were cash flowing, just because they couldn't get that debt financing. And we're not seeing that as much this time through. So if you jump forward, and then this just kind of reinforces that point. Last year, each one of these bars is a different type of capital flowing into the market. The dark blue is property acquisitions. The light blue is the value of properties refinanced each quarter. And there were some points in 2020 where the value refinanced every quarter was greater than the value being tied up in property acquisitions. And that was able to happen because of that liquidity in the debt markets. And it was able to happen. And because that was able to happen, people didn't have to sell at a big loss. So if we jump forward one more, then the big question that everybody's been asking is, great, that's where we were at. It's not going to be the same in terms of that downturn, but we have some new conditions to worry about. There's some increases in the interest rates. There's been a lot of buzz this morning about how high the rates are going today. Where are they going to go? What's that going to do to pricing? And if I knew where interest rates would be going, I'd be a very rich man. What I'm showing here, though, is just a survey that the Wall Street Journal does every month, where they ask 50 economists where they think things like interest rates will go. So they'll get about 100 answers. And so what I did here is I just took, the black line is the history plus the central forecast from all these economists. And then I just calculated, just given the range of opinions from these folks, where things are going. Now, this is a little bit dated. This came in from early February. It was been updates along the way in terms of the economy, but it's interesting to show that there's still a big division in terms of where people think things are going. I'm showing 2 standard deviations around the mean, and there's a group of folks that were thinking, as high as 3.25 for the 10-year Treasury out by 2024. And when you talk with people in the investment world, they see that kind of number and they think, well, if we're at 1.5 today, and I'm going up to 3.25, so that means I should add 175 basis points onto any cap rate I see, and we're all dead. That's the thinking that they've got. But I'm not sure that works so well. If you jump forward, Tino, and one more. Now, things don't work in a one-to-one basis between cap rates and interest rates. Now, if there's any financial economists in the audience, I know that I'm not making apples to apples comparisons here with this chart, but if it's stupid and it works, it ain't stupid. And when I talk with people in the acquisition world, there's a behavioral thing I noticed where they look at, well, what's the cap rate on a deal and what's my cost of financing? What's my mortgage rate? And implicitly, they understand that if I've got some spread between my cap rate and the mortgage rate, I can do a deal where I get some positive financial leverage. So the top line here of all 3 of these bars equals the composite cap rate we have for office, retail, and industrial, all commercial property. The bottom bar is a 10-year Treasury. And then in between the cap rate and the 10-year Treasury, I put a spread between the mortgage rate and an index we create of 7 and 10-year fixed rate commercial property loans, sort of the mortgage rate purchase. So here's the thing. The interest rates, if they do go up to 3.25, we're basically taking it back to where it was in the middle of 2018, in terms of that level. What can happen is that it's not all going to go to just a higher cap rate. Those spreads are going to narrow. If we get the interest rates going up because of positive things, because there's job growth in the economy, people are spending again, people are going to nice restaurants, going to shows. I think you can see what I want to be doing from those comments. Then property income is going to be on a positive trend, and investors will feel less fearful about jumping into investments. So that's going to help narrow that spread that they've got, and they've got more than 250 basis points of spread relative to the mortgage rates right now, which is a high level for commercial real estate over this sample period we've got. Even the debt side, it's not as though the 10-year Treasury fell to 1% lower and commercial mortgage rates chased them down. They set a floor. There was a point they wouldn't go any lower. And so, as they come up from that floor, it doesn't mean that the top line number comes up right away as well. So yeah, there's some fears that inflation will continue to pick up, and that might drive up interest rates a bit. But as long as it's coming about because of healthy figures, healthy forces, then that could help the property income side, and you don't necessarily need to see a big spike in cap rates coming out of it. So that's the summary that I had for you, Tino.
So Jim, let me ask you a question.
Yeah.
Let's see if I can go back to it and find it relatively easily. When we look at the where's the recession chart? Here. Okay.
Yeah.
When we go back and look at the coming off of that correction, we have that drop, and then we have our recovery. And we have this kind of quick turn in 2020 based on the price growth. It had been a while since we had a correction, and my recollection from MBA and CREFC and MBA might have been the last time we saw each other in person last year in San Diego. The mood was cautious for 2020 and into 2021, but at some point we're going to have the music's been playing for quite a while now, and the band's going to probably have to take a break.
Right.
And then this happened. So is it possible that this hit is separate from what would have been a correction in the market without COVID, and that we haven't felt that yet?
Yeah, in fact, you bring up an interesting point. I mean, it's hard for people to remember what it was like at times back in late 2019 and early 2020 before COVID, because this thing was so big and such a big shock. It just kind of erases so many things from the before times. But I remember conferences in the fall of 2019, there was a lot of talk around, I'm worried about a recession coming because we have interest rates going up. We've had a certain portion of growth in the economy coming from just low interest rates. And as the cost of capital goes higher, some firms are going to have trouble and there'll be a bit of a shakeout and lower growth. So that did one thing as well. Some of the trends we've seen in investment in terms of people maybe shying away a little bit more from office, a little bit more away from retail and hotel, that started before COVID. It's not just a COVID thing. There was a move in late 2019 where a lot of investors are saying, I want low capex investments because the cost of capital might be going up. And so, that was already starting to drive some behavior from before. And so we're getting over COVID. There's going to be, more people out and about seeing each other doing things. But there's some concern that that growth can be helpful, but how much are we going to see interest rates go up, and how much is that going to detract from that growth as well? It's sort of a push me pull you kind of situation, and it's I think on balance in the near term, with so much suppressed economic activity, you'll see people out and about for a bit. But at some point, there's a certain amount of growth and activity that came about from low rates, and so watching where that goes will be important and interesting.
The run up from '08, up through from like 2010, after we really started to kind of turn the corner. I mean, that was 10 solid years. I mean, I think the index had gone, 300% for multifamily from the trough in terms of growth. And we always think that we have the drop and then we have this extended period of recovery. But if we really didn't have a non-COVID trough, are we potentially setting ourselves up for this other shoe, which, but for COVID, we might be experiencing in 2021 or early 2022, and that didn't hit us yet. So that's the part that I just wonder where it could be dangerous if everyone jumps in and really starts pumping capital into the market to continue that already long 10-year trend upward and push it further. And maybe that makes a correction more painful if we have to come off of that even higher number.
There's some debate on the sources of the dry powder that's out there. There are some of my gold bug friends are saying, oh, it's just the Fed running the printing presses and that's just driving everything and the Fed drives it all. But that's not the only thing. I have a lot of clients in Asia that I deal with, in part because the savings of countries like Japan and especially Korea and China are so much higher than the United States. If you look at the ratio of the working age population relative to the total population, that's the dependency ratio. You've got record amounts of people in that prime saving age in these wealthy countries. And so that money has to go somewhere. And that's driving still a glut of capital. And so the yield type assets on offer in real estate look attractive to these groups. we're starting to come past that curve for both China and Korea, but there are other growing economies that might supplant them. You've got India and Brazil starting into that expansion phase in terms of the changes in the dependency ratio favoring savings over the next between now and 2050. The question is, will they be able to get high enough on the income scale that the savings there matter for global capital flows, or will they stay kind of lower in the productivity scale, so their savings doesn't have much of an impact? I mean, a small wealthy country saving a lot probably does more than a small poor country. That's just part of the issue.
Right.
But it's not just Fed activity driving it all. There's a global expansion of capital and a need to save.
Yeah, there was definitely a visible change in risk spreads in the debt capital markets as soon as the Fed bond buying incorporated CMBS.
Yeah, and I think part of that, that it was only a signal in some degrees. I don't think it had as much of an impact on, as them physically doing it, so much as this signal that they were willing to step in. That was a problem last time through. The government dithered and the Fed dithered for so many months that the economy kept spiraling down, where lenders were hesitant to lend because they weren't sure what's happening. So borrowers had to refinance, couldn't, and they had to sell at a loss, so prices declined, which then made lenders more hesitant to lend because prices were declining, and it became a vicious downward spiral until they stepped in and put a floor under things for a bit. I mean, there's the famous story of Hank Paulson getting down on his hands and knees and begging Nancy Pelosi, Speaker Pelosi, to act on some rescue bills. Which I've seen Hank Paulson in person, giant man. I mean, I'm tall, but it's like I feel like a little kid standing next to the guy, and so the image of him on his hands and knees begging shows the seriousness of the situation. This time through, because I think we were in such a recent memory on that, they just knew that we can signal that we're supportive, and whether the market needs it or not, them knowing that we're willing to step up helps provide the expectation that there's a little bit more safety this time, and I think that signaling helped bring spreads in much more quickly this time through.
Yeah, yeah. You definitely saw that quick pivot in the direction of spreads, or that quick pivot downward, almost as soon as the expectation was there's going to be some Fed support on AAA new issue CMBS, and we just saw the spreads come down to levels actually pre-COVID for some of the senior bonds. I did want to we skipped over the slide to talk about interest rates, but I wanted to go back to inflation concerns for real estate. I mean, that's one of the benefits, right? We take advantage of inflation as a hedge because we move along with it when you have an investment portfolio. So is there a genuine fear now that we really need to keep an eye on this, especially with some of the recent stimulus prints that we've made?
Yeah, here's the thing. I think that there's been a lot of talk about inflation because there's some momentum there, but the momentum doesn't necessarily continue, excuse me, at the same pace in the coming years. I'm showing here the spread between the 10-year Treasury and the Treasury index securities, and inflation protected securities, which is kind of approximating some inflation expectations. And yeah, from 2019, into the current period, just straight up. And so people just see that and they just mentally project, well, if it continues this way, we're going to have even much higher inflation in the future. And you talk to people in the real estate industry, like on the construction side, And there's some real problems out there driving up costs. Material costs are going up. If you want to build apartment buildings out of wood, stick-built apartment buildings, finding materials, resources, it's more difficult today. The pandemic shut down some supply lines. You just can't reopen them right away. Some of them will reopen, but it's going to take some time. And so there's some physical constraints out there that are being dealt with. And as you get through that, then you're going to have some increases in prices. But eventually, those constraints recede. I think the other thing that we're going to see is that firms are going to try and reopen. Restaurants. We're starting to see more restaurants open up. They're going to have their workers back. There's going to be competition for those workers. You're going to see some wage increases, and so that's going to lead to some inflationary pressures as well to compete to get the best folks in there. But eventually that settles out. I think some of the inflation fears we see are just the transition to growth once again. And it's not you're not in a race car going along in a very smooth transition from an automatic transmission. It's a manual transmission that's a little bit jerky because you haven't driven stick in a while. And so as you transition up to fifth gear, it's not as smooth as it can be. So there's going to be some bumps on that, but I don't think it's something that continues at that same kind of pace. I think it's something just the transition from everybody being locked up to then trying to figure out how we reopen and get things moving again.
I appreciate that. I'm looking forward to some of the restaurants opening again too, because right now I seem to be going to the same two that are located near NYU just because they're convenient and open. So there was one question came in about, is this being recorded? Yes, it'll be on the NYU Shack YouTube website. And then another question came in, given the balance of capital availability and the risk appetites for borrowers, do you feel there will be more spread compression for debt or equity returns?
Here's the thing, for debt, I think it depends in part on just how much capital has been allocated to each, and I don't have hard figures on that. I mean, Tino's chart, that might be an interesting way to digest that, because part of it's capital availability relative to demand. There are a lot of investors, though, that while they do like the returns on offer in real estate, they still are a little bit fearful. So they're trying to get something better than bonds by being in the debt portion of the capital stack, but still some safety that way. You do have a wider spread on the mortgage rates relative to the 10-year Treasury than in the past. They didn't chase the 10-year Treasury down. They hit that floor and didn't go lower at that point. So I think you might see a little bit more of a narrowing the spread of debt at first, but both eventually will.
And maybe even a little bit more of a kind of a divergence between the assets where the lenders are willing to compete heavily and compress their expectations versus other ones where they're just either it's binary, I'm not doing the deal, or you're going to have to pay me a lot of money on debt in order for me to take that.
The thing is, it's going to be the same factors that make the lenders willing to take a risk on, say, a large logistics building are the same ones that make the equity willing to take a risk on it. So, they'll both be moving in those cases.
Yeah, or does that really further that divergence between, the property types? You get a lot more of the haves and the have-nots, and that's just by property type. Then there's a whole other layer of markets, right? Yeah. The idea that New York is going to be a suburb of Florida at some point because everyone is moving south.
No, they are.
Versus we're going to be back and it's going to be just like it's always been, and maybe everything in between as scenarios.
Well, everything in between. It's not New York is not becoming a suburb of Florida. That's just a temporary situation. Uh, the Cleveland Fed did a study of sort of where people are moving, and it's not people. People aren't leaving Texas, leaving California, New York for Texas, Arizona, and Florida. I mean, there are some folks, but it's a small portion of it. Uh, what it really is, people are leaving for the suburbs, and it was underway before COVID. It just simply accelerated. Part of it was that the millennial generation, it's not a bunch of young kids living above a tattoo parlor in Williamsburg anymore. It's, they're in their 30s, they've been having kids. It's part of the natural life progression to just, move to places where there's a little bit more room to get out and about. Uh, the so that was already happening. This pandemic simply accelerated those decision making processes that people had. And as the pandemic is over, it becomes those folks are in the suburbs, but they can still tap into the same job market that they were part of before. I've left Silicon Valley, and I moved a little further afield into the East Bay of the San Francisco metro region because it's a little bit cheaper. That's part of it, but I can still be tied into that labor market. Maybe I work from home 1 or 2 days a week in Connecticut as opposed to coming into Manhattan. But I'm still tied to that labor market in Manhattan, so I get better opportunities than I would, say, in Nashville or Miami, where there just isn't much competition for the labor and the skills that I bring. And that's the real issue. Sure, a few folks have moved to Miami. The VC world, there's a few examples of that. In the investment world, Barry Sternlicht get to Starwood Capital, him and some of his top guys moved down there. But, that's him with a lot of wealth already and an established career, good tax reasons to be down there. And he doesn't need to be in the office every day. But think about instead about that 20 something who is looking for a job, looking to grow in the industry, looking to find, mentors and growth. They want to be in a city where there's a number of different job options. If I move to Nashville for the one investment bank and I lose my job, where do I go? And so just a deep potential pool of employers is always helpful. So scale matters, and I think that those 20 somethings in particular are the ones that are going to come back. The millennials were a huge generation. The Gen Z are fairly sizable as well. It's not like my group, the Gen Xers, where after the baby boom was starting to move on, we went into cities, but it was for me, it was empty. I remember, hanging out in Wicker Park in Chicago and, a $200 a month apartment. It was just crazy how cheap things were at the time because there's so little demand. But there's a much bigger group in this Gen Z, and these 20 somethings will want to be in the city just because that's where the other young folks will be. That's where the life is, just meeting other people and hanging out in the cities is, just that's just part of that age group. There's incentives, there's economic incentives that they have on that, just in the sense of, you can't get a date living in your parents' apartment, in their parents' basement.
So, well, I think we answered the few questions that we had. There was a comment about an article saying people are moving back. Who said they were going to Florida or coming back. I spoke to a broker down there that I know, and they said that if you don't show up quickly after a house is put on the market, it's going. And I think a lot of that we've seen in the suburbs as well. So there's a whole discussion that we can get into on just office and what that might look like. A lot of, I don't know yet, the work from home versus the not, and how many go back versus how many don't. But look, I think what some great points about, we're in this a year now, and the expectations when you have a year of data that where it's so volatile, that we just have to be mindful that what happened over the last 6 weeks doesn't necessarily mean that's the trend line going forward longer term. But it does mean we need to pay attention, and I just stay very close and focused, because we could start to see longer term trends, whatever they might be. And we want to just pay attention and be mindful of them. So that becomes part of our thinking, whether you're an investor, a lender, or a service provider in the market. So anyway, Jim, again, thank you very much for your time. As always, we appreciate your time and RCA support for the NYU program. And thanks everyone for joining us today. We appreciate your time as well. Happy Thanksgiving. Oh boy. That means it's time to hit the Keurig machine for another coffee. Happy St. Patrick's Day, and be well. I look forward to seeing all of you in person, the old way, with a coffee, face to face. Bye, everyone.